Welcome everyone to Vested Interest. This is Shane back again for another stock pick of the day video. Today we are going to take a look at a REIT that has been in the news a lot lately and is one that has been discussed quite a bit in the investing community on YouTube. So I thought we would take a look at it on another day that it's pulled back again. Medical Properties Trust. This is a REIT out of the real estate sector. It is August 14th. Let's jump right into the video. So if you want to know more about this company, check them out at www.medicalpropertiestrust.com. And there's their homepage where I pulled this information from. That's www.medicalpropertiestrust.com, medicalpropertiestrust.com. So we understand healthcare, we know hospital needs, and we have the capital resources that can help. MPT is a financial partner that offers more resources, more capability, and more ways for operators and investors to seize financial opportunities. So they really invest in medical properties. That is their bread and butter. Who we are, second largest non-governmental owned hospitals in the world, experience in unlocking the value of hospital real estate for growth, preferred by top operators around the globe. Here is their global portfolio mix. 61% of their facilities are in the United States, 22.4% in the United Kingdom, 3.9% in Germany, 3.5% in Switzerland, 1.6% in Australia, 1.2% in Spain, these two little slices here, 2.7% in other countries. And I don't know why they say 3.7% in other. I mean, that really should be part of their other companies, but they also do, walk-in centers. So maybe that is what they're showing here. They're not hospitals. They're like the walk-in centers, quick, drop-in type walk-in centers instead of a hospitals. I'm assuming here, so I'm making an assumption that this top of the 2.7% and above are the hospitals, and the 3.7s are other types of facilities that they own, like I said, like the walk-in facilities or elderly care facilities. Now I pulled some metrics. I usually don't get into the metrics in this part of the slide, but I thought this would be relevant here. I did pull some metrics from their most recent report here. All right, so we are looking at their peer current valuation, MPT, their current numbers, and MPT's historical average. We're going to look at non-funds from operation, adjusted funds from operations, their dividend yield, and their NAV premium. So their peer current is 13.9 times, right? Theirs is 5.3, and funds from operations and adjusted funds from operations, a little tongue-tied there, is a lot like price to earnings. So when you see these numbers, think lower is better, right? When you're looking at price to earnings, and adjusted funds from operations or fund from operations is one you want to use for REITs, similar to price to earnings. So this is similar to price to earnings, where the lower the number, the better, right? So if you look at their NAREIT funds from operations or funds from operations, FFO here, their peers, right, people who are in the same type of business, is around 13.9 times. They are currently at 5.3, so they are lower than their peers, which is better. And their historical average is 11.6, so they're currently lower than their historical average, which is good. Their adjusted funds from operations, their peers, right, the people who are in similar business, are 16.5. They are currently at 6.6. So again, they are lower, which is better than their peers, and lower than their historical average, which is 13.5. Their dividend yield, 5.8. That's their peers' average. Theirs is 14.1. Now this is elevated, and I will agree that is very high, but it is high because their cost per share has gone way down. So the amount that it takes to buy a share of their business has gone way down. So that automatically drives up the yield. That is what you want in a undervalued dividend stock. You want their yield to be higher than average. Now, you don't want it to be so high that it's not sustainable, right? You want their funds from operations, in the case of a REIT, to cover their payout, which it does. If you got into the deeper, they still have enough cash flow to cover their dividend, even though it's going to look funky here in a little bit when we look at free cash flow, the percentages anyway. But anyways, their dividend yield average is 6.3. So they are very elevated. That would speak to dividend yield theory. We'll see that as well, where dividend yield theory says they're potentially undervalued. And their NAV premium, you'd have to go in and understand the NAV premium. But I will say their historical, being under their NAV premium, again, their historical average is 17%. Under that is good, 41%, and that's significantly down, right? Their industry average is -3, which is below, which basically means, and that's because all REITs right now have pulled back. That means how much you'd pay, similar to price to earnings, for their earnings. So you are paying 41% under where they should be valued, or where the industry assumes they should be valued, right? Their typical is 17%. So typically you're paying a premium for this company. Right now you can potentially get it for significantly undervalued, and REITs in general right now are undervalued. A lot of them have pulled back, not just this one. And that is because we are in a higher interest environment, and a lot of these companies rely on debt, so their debt is going to be refinanced at higher rates. So you're seeing a lot of them pull back because people are not really sure where they are going to have to refinance their rates at, right? As their financial obligations come due and they have to refinance some of that to pay for it with debt, they will be locked into higher interest. So you're seeing a lot of REITs pull back right now, which presents value often, right? And then here's some of the claims that are being made about them, and they address these claims right out in the open. MPT consciously overpays for real estate, or consciously overpays for real estate. I don't know why any company would overpay it, but that's one of the things that they're claiming. Well, the valuations repeatedly validated by transactions with sophisticated investors achieved unprecedented valuation, a 47% gain on the sale of real estate on sale of 8 hospitals to partnerships with Macquarie. I'm not sure how to pronounce that, but that particular sale here. So they are selling some of their real estate as well. Well, you can't make a 40% gain on the sale of a real estate investment if you're buying it overvalued to begin with, unless you sold it to someone way overvalued, which I don't care if they're selling real estate overvalued, so long as they're making a gain on it. 47% gain. I hope every piece of real estate that I buy, I can make a 47% gain or more. All right. Here's another one. Completed sale of Australia portfolio at 5.7% cap rate during a period of global capital markets. So again, they're selling some real estate to help raise cash because they do realize they're having some issues, but they're making a premium on what they're selling. So that is good. Executed and or announced nearly $500 million in profitable asset sales of prime. MPT engages in round tripping of rents. You'd have to look into what round tripping of rents is. That's way too deep for me to get into on this video, but if you're interested, round tripping of rents. It is simply not possible to round trip funds sent directly to third parties. Virtually all of the $27.5 million investment in new hospitals near Houston, Texas, for example, paid directly to the former owner developer of the real estate, along with contractors, architects, supplemental, or third parties. If they were doing what they claimed, you'd be able to see it, right? They're not giving $27.5 million in duffel bags of cash. They're using banks, right? You have to, these are tracked. You have to track the amount. Anything over $10,000. If you or I deposited $10,000 in a bank, they track it. You think they're not going to look at where $27.5 million is covered? When MPT acquires 11 hospitals as part of the IASIS Stewart mergers, it paid $1.4 billion directly to an IAS bank account. So again, they're paying $1.4 billion. This number's tracked. There's no way for them to fudge the numbers. Okay, again, these aren't duffel bags of cash that are being, shuffled around in back rooms. Tenants are in a weak financial position and unable to continue paying rents. They are having issue here. Recent acquisitions demonstrate MPT's careful lease structure and effective portfolio management, outstanding financial outcome and validation of underwriting and master lease structuring for Pipeline Los Angeles hospitals. So they're addressing just certain locations, not all of them. Expect resolution of prospect exposure with reasonable likelihood. All Q1 23 assets are recovered. Long-standing diversification goals achieved, including Steward concentration. So Steward is one of the clients that is having trouble, and this is a projection, right? This is not necessarily a fact. This is just what they are projecting out. With improving macroeconomic trends for hospitals, seeing strong and improving tenant rent coverage, as well as rapid tenant balance sheet improvements, especially for Steward. So that's, again, the same one that they're having trouble with. And it is true. During COVID, they had a lot of trouble with their tenants, right? People weren't going to the hospital. Now people are going back to the hospital. So a lot of these issues that they're having with their tenants are naturally going to work themselves out as people go back into hospitals, have procedures that they were putting off, especially elected procedures like my wife just had one for some issues she was having. Wasn't covered by our insurance, so we waited until everything was sorted out with COVID before she had the procedure, right? So there are a lot of people doing exactly that. Now let's get into the actual fundamentals here of the company. We are talking about Medical Properties Trust, ticker MPW. This is a REIT out of the real estate sector. They were down 3.28%, and they've been down significantly. They bounced back here a little while, and now they are down again as well. So one that is down significantly over its 52 weeks 52-week range as low as $7.10, as high as $16.81. So feel bad for the people that were buying it up here at $16.81 because, boy, you have really seen this one decline. Average volume 11.9. Today was 11.912. Today was 11.918. So really not much more volume than typical. Market cap of $4.676 billion, a beta of 1.02. So even though they're having a lot of troubles, they are really in line with the market, just a little bit more volatile. Price to earnings ratio, PE ratio, 15.63. We just looked at funds from operations. That's a better metric to look at, but this price to earning is not terrible. Their earnings per share is low, right? This is a low earnings per share. I will say that. Earnings date October 25th through October 30th. So you'd want to look at this and keep an eye on it, see how they're doing. Any company that is potentially having problems, you want to, and especially if it's in your portfolio, you want to make sure you're tracking those companies that are having problems. This one is one that is currently having some short-term problems. I believe they're short-term. They may be long-term. I may be completely wrong, and this one is a sell all day. Who knows? Forward dividend is $1.16 paid out on the year, which is a 14.36% yield. That is because the price of the shares have pulled way back, right, from $16.80 to $7.82. So that drives up the yield. Ex-dividend date, June 14th, so that was today. So that is part of the reason for the drop as well. You always get a drop on the ex-dividend date. And their one-year target estimate is $11.20. So Yahoo Finance sees a upside to $11.20 per share, right? So it's significantly undervalued, at least according to them. And let's jump into statistics. I like to look at dividend yield theory, which we already kind of did. You look at the current 5-year average, 6.65. Their current is 14.36. That speaks to a significant undervaluation, at least according to dividend yield theory. Now, here's where things get a little wonky. Payout ratio, 1,054%. Not good. That's extremely elevated, even for a REIT that has to pay out 90+% of their free cash flow. That is very, very high. This is something to watch. Free cash flow, let's take a look at it. 2019, $494 million. A rise in 2020 to 617, another rise in 2021 to 811, a drop from 2021 to 2022 from 811 to 739. So you'd want to watch this as well for 2023. If you were to continue to see a decrease in free cash flow, that could be concerning. That would be a 2-year trend, right? That is not a good sign. Let's jump over to stockanalysis.com. I'm not affiliated with stockanalysis.com. I'm not affiliated with Yahoo Finance. Just two sites that I like to go and look at. They have 10 stock analysts that are taking a look at this. They call it a consensus hold. Now, if you were going to go into their site, you'd be able to click on these. This is a strong sell. This is a sell. This is a hold. This is buy. This is a strong buy. You would see 4 strong sell. You would see, I think it was 6 hold, and you would see 5 buy. No strong sells, no strong buy. So they are a mixed bag between sell, hold, and buy right here. Little closer to buy than they are to sell or to hold, on hold, but they are a hold nonetheless. Now, they have a low estimate of $8. It currently sits below their lowest estimate, so that would be a 2.76% increase in the stock price. If it hits their average of $11.20, which would be right in line with what we saw with Yahoo Finance, that would be a 43.87% increase in the stock price. And if it happened to hit their high of $15, that would be a 92.68% increase in the stock price. Waiting for it to hit one of these, $8, $11.20, or $15, you'd be able to collect that 14% dividend yield if you were to buy them now. So anytime I see a company that is trading below the lowest estimate, right, which it is, that tells me this one may be one to look at. Is their dividend yield in jeopardy or of a dividend cut? Possibly. I mean, if their free cash flow continues, which what we saw was 1,000% payout, if it continues like that, I would say they need to cut their dividend yield. But even if they cut it in half from 14% where it's currently at, that would be 7% dividend yield. I mean, that's a pretty good dividend yield. And that would be cutting it in half. All right, return on equity, return on ROE, and return on invested capital. If you were to jump into statistics, these are two I like to look at. Now, I like 10% or better, or in line with their industry average. This is neither. Return on equity sitting at 0.8%, return on invested capital sitting at 1.2%. So below where I like them to see on both of these numbers, and significantly below where I like them to see, and which would make sense since they are having some issues with tenants right now, right? So this makes sense because of the issues they currently have, but another strike against them, right? These do not meet the metrics that I want. So free cash flow decreasing from 2022 or 2021 to 2022. Elevated payout ratio does not meet return on equity, does not meet return on invested capital. Let's look at the dividend. again, as we saw, 1,054% payout ratio, very, very elevated, something to watch, something to be concerned about it for sure. They are increasing the dividend. I would say they need to stop increasing the dividend until they get things under control, but they are decreasing the dividend from 2020, 27 cents, 2021, 28. 2022 in March jumped up to 29. They've held at 2029, which I believe they should continue to hold it. If not decrease it, this would be a company that I would recommend possibly decrease it if their free cash flow does not get under control here over the next couple of quarters. Now, in all, just putting it out there, I am long MPW. Full disclosure here, I own currently 590.707 shares. I am down 21.42%, so I'm down $1,260.70 on this position. And what did I do today? I put a cash secured put on this at $8. So if it maintains at $7.82 under $8, I'm willing to buy another 100 shares of MPW at $8. I feel it is undervalued. Even if they cut the dividend, I feel like that's already priced in at these under $8 prices. So for me, I am going to continue to add this position. I'm going to continue to decrease my cost basis, increase potential future returns. I think it's probably close to a $10 stock, and that's why I'm willing to be under $9.95 here and under. That's my cost basis, so I'm willing to continue to buy and add to this position. And with a high dividend yield at 14%, even if they were to cut it in half, I would be comfortable holding it with a 7% dividend yield. That's where I'm at. I noticed there were some comments on some recent videos of mine, so I thought I would address this one. This is a bit of a speculative play right now because of the potential issues they are having with some tenants. I completely understand that. I am willing to hold it at these prices. Anything under $10, I am willing to buy. If it ran back up to $12, I might look at even trimming it out of the position, and I probably will continue to run some covered calls and cash secured puts on these shares here and generate some income that way. I mean, I made 3% on my money today by running this cash secured put, whether or not it hits. And like I said, if it does, I'm comfortable adding another 100 shares at $8 on this one. That's where I'm at with it. Let me know in the comment section below what you think. I completely understand if it's one you're avoiding. And guys, I'm not afraid to make a mistake. This is 2.86% of my portfolio. So we're talking about a position in my portfolio, less than 3% of my overall portfolio, $170,000 portfolio. I'm not super concerned about one position at 3%. Even if I was to have to sell this at a loss, that would be part of my tax loss harvesting, which I try to do every year anyway. I know I'm going to make mistakes. I use those mistakes to my advantage to offset some of my gains. This would be one of those ones where if I had to do it, I would spread these funds, the remaining $4,616, over the rest of my portfolio into the existing positions. That's what I am doing with MPW. That's my thoughts on it. Let me know down in the comment section below what you think. This is the vested interest stock screener. This is how I look. So if we were to look at this, right, understand the business, this is also how I set up the videos, growing free cash flow. So they do not have growing free cash flow over the last 5 years, so that would be a check against. We do understand the business. Growing dividend, they have been growing the dividend. That would be positive towards them. Dividend payout ratio of 75% or less. This does not apply to REITs, but right now it is elevated, extremely elevated, so that would be a check against them. Check valuation based on dividend yield theory, potentially undervalued according to dividend yield theory. Buy below current cost basis. Yep, I'm buying below my current cost basis. Return on invested capital and return on equity greater than an industry average or 10% or plus. It does not meet that criteria. And for financial companies, add valuation. You can use price to book, which is what we're talking about here for any company. And when I looked up their price to book, they're at a 0.58. So according to price to book, they are undervalued as well. But I don't really use that for every company. I really focus on that for financial companies. But for this one right now, it's at a 0.58 price to book. Anything under 1 is undervalued. So that is MPW. That is how I look at the company. That is just a breakdown. Like I said, that's the numbers. Let me know what you think down in the comment section below. As always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up. Ring the notification bell. Most importantly, subscribe to the channel. Join us on this journey of financial freedom. Join the vested interest community, building a community of like-minded dividend investors so we can share our experiences, share stocks we're watching, stocks we're avoiding. This may be one that you are avoiding altogether. Let me know what you think about that. Why are you avoiding it? Why are you buying it if you are? I do personally read and respond to the comments. I'm always interested to read your questions, opinions, or suggestions for future topics. So if you have stocks or companies that you want me to cover in the Stock Pick of the Day series, drop them down below and I'll work them into the rotation. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by, and we'll see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion and investing journey for educational and entertainment purposes. Investing involves risk and money. You should never invest any amount not comfortable losing. Always do your own research. Invest based on your situation, circumstances, and select criteria, or seek the advice and counsel of a certified financial advisor.